Now we're going to discuss how the amount of current assets will affect the profitability of the business. Now over here you can see that there are three alternative policies regarding the size of current assets holding. Number one is relaxed, and you have moderate, and then you have restricted. Now in the relaxed policy, basically a lot of current assets are kept in order to remain safe. So you can see in the relaxed, the current assets per $100 of sales is the highest over here, and in the moderate you have lower amount of current assets, and in the restricted you have even more lower amount of current assets. So the top line, which is your relaxed line, indicates that the firm holds a great deal of cash, marketable securities, receivable, and inventory relative to its sales. And when receivables are high, it means that the firm has a liberal credit policy. It means that they're giving a lot of days for the receivables, their customers, to make their payment. On the other hand, a restrictive or a tight, and also called a lean and mean investment policy, holdings of current assets are minimized, and a moderate lies between these two extremes. Now let's see how does this have an impact on the profitability of the business. So for that, we're going to look at the Dupont equation, which is return on equity is equals to profit margin times total asset turnover times equity multiplier. Now here are the formulas for each of the sub formula. So profit margin is this, total asset turnover is this, and the equity multiplier is this. Now a restricted policy, let's go back. What does restricted policy mean? Restricted policy means that there are lower level of assets. It's basically this line, which means that there are lower level of assets kept. Now because of a restricted policy, you will keep lower level of assets. Lower level of assets would mean that your total asset turnover will be high, because if your denominator is less, automatically this is going to go up. So if your total asset turnover is high, that would mean that your return on equity is high. It's simply math. So if your denominator is less, the answer that you get from this is going to be high, and because it's multiplying over here, your return on equity will be high over here. So if you keep a restricted policy, you will get a high return on equity. However, this policy will expose the firm to risk because of shortages that can lead to work stoppages, unhappy customers, and serious long-run problems. So business needs to be prudent about how much of the assets they need to keep. If they keep too few, then they might lose on customers and sales. Similarly, if we look at the other way around, if we keep a relaxed policy means that a lot of assets are being kept. That would mean high level of assets, which would mean a low total asset turnover, because if this is high, then your total asset turnover will be low, and that would mean a low return on equity. So if you have a relaxed policy, you will be safe. So it is very unlikely that you will miss on sale opportunities, or your customers will be unhappy, or there will be work stoppages. However, then in that case, you will have to go for a lower return on equity. And the moderate policy is going to fall between the restricted and the relaxed policy. Okay, so now before we begin understanding this, there are two types of current assets. So one are the temporary current assets, and the other are the permanent level of current assets. Mostly businesses, they see a cycle in their sales. So sometimes sales will increase, sometimes sales will fall, depending upon the season. However, permanent level of current assets is maintained by the business, which are the current assets which will be needed at the lowest level of the business cycle. And then when their season will peak, they will keep more current assets in order to meet that higher demand, but that is going to be temporary. Now, in the moderate approach, the maturity matching approach, it calls for matching the asset and liabilities maturities as shown in this diagram. So the permanent assets, that includes the fixed assets and the current assets, will be maintained through long-term debt plus equity plus spontaneous current assets. whereas the temporary current assets will be maintained through short-term debt financing. So it is actually matching the maturities. The temporary one will be dealt with short term, and the fixed one, the permanent assets, will be catered through long-term debt. So according to this policy, if inventory is expected to be sold in 30 days, it would be financed with a 30-day bank loan. A machine, if it is expected to last for 5 years, it would be financed through a 5-year loan. A 20-year building would be financed with a 20-year mortgage bond, and so on. However, there are two factors preventing an exact maturity matching. Number one is that there is uncertainty about the lives of the asset. You cannot be perfectly sure how long that asset is going to stay with you. And the second is that some common equity must be used, and a common equity has no maturity. So you cannot do maturity matching over there. Then the second type of approach is called relatively aggressive approach. Now, in this approach, you can see that some of the permanent level of current assets are also being financed through short-term financing. And some of them are being financed with long-term. Now, depending upon the manager, this dashed line can be anywhere. So it might be possible that all of the permanent level of current assets, so the dash line might be somewhere over here, and it might be even somewhere in the fixed asset. That would mean that the approach is even more aggressive as this dash line moves downward, because then more of the permanent assets are being financed through short-term loans. Now, why would the manager do this? The reason is that usually the yield curve, the normal yield curve, is upward sloping. This means that the short-term rates are generally lower than long-term rates. So the loan that you get on short-term loan is usually lower than your long-term loan. However, I'm using the word usually, so it can be different. There are different type of yield curves as well. So this strategy is therefore quite risky, because it is very volatile. It is going to be very uncertain. What if once a short-term loan ends and the business is unable to refinance that loan, or once they're going for refinancing, they're getting really high interest rates? Then moving ahead, the last type of approach is the conservative approach. So panel C of the figure shows that the dashed line is actually above the line designating permanent current assets. This is indicating that long-term capital is used to finance all of the permanent assets and to meet some of the seasonal needs as well. So basically mostly all of the financing is being done through long-term, and only this shaded area is being financed through short-term financing requirements. In this situation, the firm uses a small amount of short-term credit to meet its peak requirements, but it also meets parts of its seasonal needs by storing liquidity in the form of marketable securities. We'll study what are marketable securities later on. So this is a very safe and it's a very conservative type of financing policy. Now, which approach is better? There is actually no correct answer to this, and it would depend completely upon the manager's decision, and it might even include some of their personal preferences as well. But there are some points to note. That first, the cost of short-term debt is generally going to be lower than long-term debt. So these are some factors that should be kept in mind, that the cost of short-term debt is generally going to be lower than your long-term debt. And your short-term debt is liquid, so you can even get out of it very easily and you can negotiate much faster, and it would offer a greater flexibility. So there are advantages of financing through short-term debt. However, short-term debt means that there will be relatively more risk, or basically there will be more financing risk, because short-term debt means that you will have to continually keep on looking at the debt market and negotiating, and the same problem arises that what if you are unable to refinance, or what if when you're trying to refinance you're getting a very high interest rate.